everybody. My name is Michael Scott Forehand. Today is the 16th of November, 2023, and we are meeting for a special edition of the DFL IBC class training presentation, whatever you want to call it, that we do a couple of times a month. Today we have a special guest, Mark Creighton, our Regional Vice President from Mutual Trust Life Solutions. We're going to go into some of the new and upcoming things and some of the really interesting things, especially with the way the markets are going and what's happening with infinite banking. And I've got some other not anecdotal evidence, some other evidence about how valuable these programs are and what they can mean to you and your clients. And if you happen to be one of the folks that I invited here as a client, welcome. And then hopefully you'll get something out of this. So we're just going to go ahead and dive right into this. Mark, welcome, Mark. What do you have to say for yourself?
I am glad to be here. Appreciate
Right on.
it. I see a lot of names I know here. Very excited.
Very cool. Yeah. And so for those of you that are just new to infinite banking, what an infinite bank is, it is a specialized type, the way we structure them, it's a specialized type of life insurance that we can use either in the form of a debt elimination strategy, which would be called a debt-free life bank in that case, or it can be used as a wealth growth, wealth preservation, or wealth transfer vehicle, which is why we call it an infinite bank. Okay. We've got three primary carriers that we use for this here at Symmetry Financial Group, which we use Foresters Financial, Lafayette Life, and we also use Mutual Trust Life. Each of them has a different space, and they have different reasons why you'd want to use different programs based on your client's needs. For the most part, I use Mutual Trust Life. I'm familiar with their quoting software and their quoting system, and it makes it easy to manipulate the numbers to create programs that grow wealth at a significantly faster rate in some cases than the other carriers. But there's different reasons why you want to use them. They're all good. They're all great companies, and they're all A+ rated companies, and we love all of them. Tonight we're going to be focusing on Mark's company, which is Mutual Trust Life, and some of the interesting things that have happened recently. And I'll just make one piece of one reference here. If anybody follows the market, it was 104 billion. There's 104 billion dollars that left the equity market last month, and it went primarily two different places. And one of the places is the infinite bank programs. And the other places there's a lot of new annuities are really strong right now too. So if you can read between the lines, who's moving money out of the market, it's the wealthiest segment of our population. And why are they moving money out of the market? Because they all have a concern, as we all should at this point, that the markets are getting ready to be a little not as bright and cheery as they have been in the past year or so. So with that in mind, let's go ahead and get Mark. Mark, welcome to the party, man. I appreciate you. Thank you for coming. Thanks for being here and pouring into us.
So, it's my pleasure, and I am so excited. If you've heard this before, bear with me a second. So I'm coming up on 20 years with Mutual Trust. And when I first started with the company, I was on the sales desk, learning what we did. And shortly after I started, about end of 2004, we started getting these weird policies submitted to us and placed, and these agents who never really knew before coming to do business with us. And we were excited because, we're all in sales. We get excited when there are sales. And then you stop and go, what is this? So when we were done high-fiving each other, we made some calls, and the regionals at that time did, and talked to those agents who were new to us, wanted to do business with us, found out it was something called infinite banking. We said, God, that's cool. All right, what's infinite banking? And they said, Mark, you are now the infinite banking coordinator. And I said, cool, I've been here 6 months and I got a promotion. And I had to go learn what it was. I was doing webinars, and thank God they're not like this, where I could see all your faces, because you would have seen me with my head down, flipping pages, looking up books, teaching people how to do something I didn't quite understand yet. But infinite banking got popular, and um, and then several years later, let's call it 2008, 2009. Everybody know what happens then. Little financial crisis. Interest rates crept up. And when an individual wanted capital or wanted money, they had to go to a bank because that's typically how everybody does it, right? What were interest rates back then? They weren't friendly. Business owners were looking at 10+% and having to prove they don't need it to get it. God forbid you actually needed it. IBC was never as popular, or it was never as popular as it was then. It's been popular ever since, and actually sort of growing, but it was perfect back then. We are now at a place in time in the economy where you're seeing that happen. Scott just alluded to money leaving markets going to safety. There is not a better solution and not a better time for your clients to be. Actually, they should have been looking at it about 2 years ago. Get ahead of the market, put as much money away. So when you start seeing these things, you've got ample cash values available for you to do what you want to do.
Mark,
Infinite banking.
I,
Yeah.
I'm sorry, I just want to add a little bit of color to what you just said. So if you're looking at the capital markets 10, 12, 15, 20 years ago, if you weren't in a space where you're able to get capital money because you couldn't prove that you didn't need it, then your alternative was to go to hard money lending. And if you're going to hard money lenders, you're not getting 10 points. You're getting 16, 18, 20 points with a 6-year balloon, with a 6-month balloon. So it was really, really unattractive. But if that's all you had available to you, then that's all you had available to you, which is another reason why these programs became so popular. Sorry for interrupting, but keep going.
No. When we think about those wealthy individuals and what they're doing and what infinite banking is, if you spend some time on YouTube, there's a lot of videos now. Everybody's talking about IBC. 20 years, 15, 20 years ago, I don't even know if YouTube was around. If it was, you couldn't find infinite banking. But now you Google infinite banking, all kinds of things come up. A lot of the stuff that's out there is good. There's a lot of stuff that's 80% good. The 20% crap stuff is, everybody's got to be careful on. It's not magic. It is a great strategy and a diligent a focused approach to handling your money, and it's doing so with the best safe asset class product there is. So good, that's where banks go. Scott will probably talk about that in a bit, but life insurance, permanent life insurance, specifically whole life, is immune from any market fluctuations. Market goes down, your cash value is going up. Market goes up, your cash value is going up. Interest rates go up, you see things like I'll talk about later. Scott, tell me when I can actually say it. Interest rates go down a little bit. Hey, policy is still growing. You're still participating in all the profits. But it is absolutely the best time. And Scott and I were talking earlier in the week. I was on my bank's mobile app checking out something. I got approved for a $45,000 new car rate. And this was last week I got it. And when I looked at, I'm like, oh, interesting. First of all, my wife will kill me because I just paid off my car. She will literally kill me. But I clicked on it and I'm like, oh, interesting. Let's see what this is. And I'm like, and it was great. It was like literally click this button, take this, show this to the dealer, and choose your 60, 66, or 72 month preference, and up to 45,000. There's some contingencies, not more than 4 years old, less than 125,000 miles on it. Like, they're going to let me buy a $45,000 car with 125,000 miles and finance it for 6 years. Wow. But I looked at the rates. 10+% on each of the options. I looked again the other day because Scott said, can you get that on? And I couldn't figure out how to pull that out from my mobile app. but the rates are now 11+%.
Nice.
So yeah, quite a nice deal. If I wanted to finance my car, guess where I would be going? I would be going to the policy. And yes, policy loan rates are going to be increasing, but nowhere near what the market is doing to interest rates. Policy loan increase, like I personally believe where our policy loan rate is right now and going, it's going to be increasing in December 1st. Anybody with a variable loan rate probably either has or is increasing their rates. This is the best time. This is the sweet spot. It is the easiest for people to understand how powerful it is to have capital at your disposal that you choose how, when you use it without begging.
Let's dig in there. Okay. So we're talking about, if you're talking about getting money from the capital market right now, where you're going to get it from banks, from other private lenders, potentially from commercial lenders, if you have commercial lending relationships, those kinds of things. But the rates are not going to be anywhere near what you're going to get from your private bank. So let's put that in perspective. So you just mentioned an 11% car loan rate.
Hmm?
That's because I'm sure your credit's not shot. I'm sure you've got good credit. I'm sure
I do.
you're 750 plus, I'm sure, right? So
Yeah.
that's going to be considered good credit. So that's what someone with a good credit rating is getting. 11 on a car loan.
They
Okay.
like me.
And that's because they like you, right? That's because you probably don't owe a whole lot either. So, this is that old adage: if you need money when you borrow from a bank, they won't lend it to you when you need it. They only lend it to you when you don't need it, right? So
Hmm?
now you're back. Okay, so I can borrow the money from myself, and even if let's say the market rate goes up to 5.5, to borrow it from myself.
Mm-hmm.
And let's say I took my policy out 2 years ago when the guaranteed interest rate was 4%.
Mm-hmm.
That means my delta is 1.5.
Mm-hmm.
That means my realized loan interest rate before any dividend is 1.5%. Or I can go to the bank and take it out at 11.
Mm-hmm.
Did anybody just have a holy cow moment?
And
So,
truthfully, Scott, that's the delta if nothing happens. If I am an honest banker and I am putting the peas back on the shelf, as Nelson likes to say, what does that mean? It means I'm paying my loan off because it is a true debt. If I walk away, the insurance company is going to take from me. I owe somebody. Um, the power is my policy is still whole. I didn't use it. It's collateral. Um, if I'm paying back my loan, I'm making monthly payments. Even if I skip one, I'm reducing that principal balance. My insurance company doesn't collect interest on money that's paid back. We're only charging interest on the outstanding loan balance. So we're not interested in getting rich off of loan proceeds, loan interest. We're just replacing the investment income we would have had we had that money in our control. But it's yours, so you get to use it.
all right. So I want to go deeper here also, because we heard you were on Symmetry's call yesterday. One of the things they talked about was arbitrage. They mentioned arbitrage. So let's talk about that for a second. Let's say, this is beautiful. Let's say I have $100,000, just for easy, fast math. I have $100,000 in my account, in my private bank, because I've been working on it for 4 years. Great. The interest I'm going to earn this year at the 4% rate is $4,000. And let's say I want to go buy that car. I want to spend $50,000 for that car. So if I borrow that car, if I borrow the money from a bank at 11% for that $50,000, that means I'm going to pay $1,100 a year. No, it's 11%, 0.11 times 50K. That means I want to pay $5,500 a year in interest, standard simple interest. Okay. That means if I got a 4-year loan, just for fast math, that means I want to pay $20,000 in interest on that car. It's really not, I know that's not the real number. It's probably a little bit less than that. Okay, but I'm just doing fast math here. So I'm going to pay $20,000 over the course of the next 4 years in interest on that car loan, and the car is paid off. But in that same respect, I've got $100,000 in my program. My program is earning 4% per year every year before dividend. I'm going to earn 16,000. It's
Pretty good
a
stuff.
brainer. Is an absolute no brainer to borrow the money from yourself, because actually I'm going to pay 16,000. I'm going to earn 16,000 in interest. I would have paid 20,000 in interest in the bank loan, but borrowing it from myself at a net delta of well, let's say it's 5.5. I'm going to pay half as much interest, and I'm going to earn more interest. So I'm going to engineer arbitrage. If you think about it in the term of net wealth, what did I do? By buying that $50,000 car, borrowing the money from myself, and I've taken the money out of my private bank, my Infinite Bank, and I've purchased the vehicle. I now have 100% equity in that vehicle. My net wealth by buying that vehicle using money from my private bank, my net wealth is now $250,000 because I have the equity in that vehicle. My net wealth is 250. And I'm going to be earning more interest on the money I've got in my private bank than I'm going to be paying interest on that loan that I'm going to be paying off over time. And whether I want to charge myself that net 1.5% interest rate on that car loan from myself or not is irrelevant. It is relevant, really, but it's not. It's not. It's not that big a deal. I'm good because I'm earning more on my money that I've got in the program. So not only did I generate arbitrage, not only did I have that money work for me for the rest of my life, I increased my net wealth. And guess what? In 2, 3 years, I can do it again and again and again. And that is the power of these infinite banks. Sorry to derail you, Mark, but I just wanted to make that point. It's about the arbitrage.
You know what else is great? You know what else is great? Let's pretend your policy has 50,000 worth of cash value and you're able to borrow every penny. Can't quite, but you can borrow every penny. So I use my whole policy as collateral. I get 50,000 from mutual trust. I go out and buy my car with cash and I start paying myself back, right? Not myself, I'm paying mutual trust. But as I pay mutual trust, what happens? The money doesn't go into the policy, it's already in the policy. What happens is the collateral assignment against the policy goes down. My available capital to use again goes up. So let's say halfway through my amortization period, now I've got 25,000 of equity, usable capital back in my policy. Loans half paid off, and assuming no other growth. My policy kept building for the next 3 years, but simple, let's imagine it doesn't. Now my wife and I decide, hey, we got a little cool project. We want to go build the deck. It's going to cost us 25,000 on our house. If I went to GMAC, or I went to Chase, we'll sell them out. That's my bank. They're offering me 11%. If I go to Chase and say, hey, we'd like to do a little deck project, and I need 25,000 to do this project, they're going to look at my income. They're going to look, debt to income ratio. I've got a car loan on the books. So in order for them to lend me money, they're going to have to make sure that I'm going to be able to pay that back. And maybe I can, maybe I can't. But what if I can't? They're going to say no. So the deck project is a pipe dream. It doesn't happen. Maybe when the car's paid off, fingers crossed, we don't need another one and nothing else comes up. Until my income goes up or the other debts go down, I can't do anything. But wouldn't it be cool if you could call Chase and say, hey, I paid off half my car. Can I get some of that money back and use it again? Mutual trust, I just go, hey, I got 25,000 there. Hey, can I get another loan for 25,000? I'm using the money that I paid back for the car. So I can reuse money as I'm paying it back. So kind of using the same dollars for a bunch of different times.
That sounds a whole lot like dollar cycling, Mark Creighton. Cycle to the dollars over and over and over again. That sounds really familiar.
Yeah.
Yeah. Of course. That's beautiful, right? So this is about, and one of the things that Mark just said here, that's the loan qualification, right? It doesn't show up. It's not on your credit report. All of a sudden, by buying that vehicle, you're increasing your net wealth. and it doesn't do anything but help you by doing it this way. It really is an absolute no-brainer. And
Mhm.
this is something else that I wanted to talk to people about. There's a cottage industry here, and it's going to be coming. It happens every time the interest rates go up like this. Every time interest rates go up like this, people the capital markets get tight. It becomes more and more difficult to borrow money. So there's a cottage industry that gets created by who? By people that have liquid capital sitting on the sidelines. And this is a great place to store liquid capital, because all of a sudden you can't go out and make 15% with your money right now anywhere. Not really. Okay. But let's say you have money to lend, and you can get into one of those lending groups. I'm not going to advertise for any of them, but there's a bunch of them out there. This is funding for lending group access. You can become the bank, and you can start making 15 points. Holy cow. What do you mean? Yes, I can borrow money from myself at 5.25, 5.3%. I'm going to make interest on it anyway. So my net delta is going to be 1.5%. And I'm going to use that money and enter into one of those lending groups. I'm going to make 15 points with my money in a lending group. Cottage
Did I ever tell you?
right there.
Did I ever tell you a story about the dentist?
No, tell me.
Dentist had a policy, and primary use of the capital in the policy was to do some improvements within the office. Older office, need to update equipment and do all that, and he was going to finance it himself. And it was also going to be used as part of his retirement plan. Self-employed dude, you got to think about himself. So, hey, I can use the money now. I'm going to use it again later. Along the way, the agent happened to notice on the dentist's counter, whatever, was a pamphlet. If you need treatment, and treatments are expensive, and insurance is great, but insurance doesn't cover a whole lot of dental treatments, at least most coverages I know. Saw a little pamphlet, read through it, and he's like, oh, this company will finance your treatments. 20 whatever credit card interest rate, right? So he's waiting to meet his client. He's in the dentist office, makes an appointment to see him after hours, late appointment. Guy's got to finish with his clients. He comes in, he says, I got an idea for you. Hey, I wanted to review your policy. You've done well. You've made the improvements. You've got some cash sitting here. You can go in the financing business too. So with a little bit of work and, advising properly, he said, I'm not an expert. I recommend you get with a lawyer to draw up a contract, a promissory note. And the guy was kind of in a small town where he knows all his clients. So the risk assessment is pretty, he's got to underwrite his clients. Are you worthy? Hey, Scott, geez, I've known you and your family forever. You're good for this. I know you're going to pay me back. Even if you skip a month, I know you're good for it. I'm going to, you need this treatment. You were going to finance here. Let me offer you this. I'll give it to you at 10%, 12%. Pick a number. And I can arbitrarily pick, hey, Scott, you're 10. Leah, I like you better. You get 6. No offense, Scott. I love you. But he got into the financing business. He paired with the collection department, and really the cost, the loss exposure for him was very minimal, because what he was doing, he was able to get more business, because this was at a time money was really tight and people weren't doing anything. He was seeing people say, it'd be like right now, how many people are not going forward with treatments because they're scared to part with the money? They're like, I'll put it off. I don't like everything costs more. I'm not going to do this right now. Problem gets worse. It's going to be more expensive. Instead, let's treat this now. Let's get you taken care of. I can finance it for you. So he was making his money make money, just idle money, just the different ways. Also knowing there's another story of a dermatologist who had a policy, much the same thing, using it to run her business, do it. She was cycling her business expenses through her policy, and it was for retirement. And she started lending out money to the other doctors who were in her office space because they were complaining about how having to go to the bank. She's like, how much you need? I'll draw up terms. Here you go. It's having, capital is king. Takes money to make money. If you had money, how would you use it to make money for yourself? And to have it in a product that's guaranteed insulated from markets up and down, guaranteed to go up every year. How important is that? Sure. Could you do it in a bank? Yeah, it's great, but it doesn't grow once you use it.
Right.
Doesn't provide a benefit to protect your family. Doesn't provide living benefits.
Right. Yeah. Actually, Mark, one thing you just said, that's actually some resistance I got about 3 weeks ago with one of these programs. And the gentleman said, you know what? I just got an offer. I think it was actually from Chase. I just got an offer from Chase for a high interest savings account. They're going to pay me 5% in my savings account. And
Today,
it took 2 seconds to defeat that argument. The simple defeat was, okay, great. So when you spend that money out of your savings account, how much is it earning for you then? There you go. There's your answer, right? Zero, right? So the
yep.
idea is that I can't think of a way when it would be better to save money in a bank, a regular brick and mortar bank, unless you're trying to have money on the books. That's the only place I can think of where it's advantageous. Let's say you're going to go get a $9 million commercial loan and you need to show enough assets. That's the only time I can see where it would be more advantageous to have the money in a regular bank or a regular checking account or something like that, where you can prove the value of it. But you know what? Just move it.
And the thing is the 5%, and we're seeing this. We've seen this in the marketplace where clients got hesitant to do this, which is the strangest thing. They were hesitant because, well, I can go to the bank and get this great rate. Well, that's today. I mean, I've got emergency savings in a money market account, and I remember I was getting 2.5%, and that whittled away down to nothing in a heartbeat. When interest rates go down, I'm not getting 2.5% in there anymore.
Yep.
When interest rates go down, my policy is still performing on a guaranteed basis exactly the same way. That doesn't change. The only thing that will happen is that probably means I'm not getting as much dividend
Right.
as I would have otherwise. It doesn't make sense. It's not good. I will always have enough emergency money where if I need it right now, I've got just enough to tide me over. Everything else, if I need it in 5 days, I call up my company and just say, hey, deposit some money for me, and it's done.
Yeah, Mark, I'm going to be in Mexico in about a week. I need to take some money, so I'm going to go ahead and take it out now. By the time I get to Mexico, it's waiting for me.
Okay.
Right. All right. So where we go from here, Mark, I know there's some other things you want to talk about. We had a discussion a while back. We talked about how are the dividends created. We talked about Moody's bond yield and how that plays into this whole scenario of interest costs versus loan dividend rates and things like that. So we're not going to rehash that, but I know you've got some news. So this is the Mark Creighton show today. So we're going wherever you want to go with this, but I know you've got some really interesting things to talk about, which I cut you off earlier. I gave that little dangled the carrots. Now you can go ahead.
Great. Well, it is a fun time. Interest rates are up, and specifically regarding high valued corporate bond, which is our primary investment. All insurance carriers invest in the same highly rated corporate bond unless they're a double B rated company, in which case they're doing other things too. But your highly rated companies are all investing in the same things. And what we're seeing is those bond rates have gone up. If you ever want or ever talking to a client, one of the easiest things to look at to give you a pictorial example of where life has been is check out the 10-year treasury bill. Look at those rates and you'll see low and then climbing. That sort of matches the shape of what we're seeing there. It's not perfect numbers, but it's the shape. Mid 2020, right really at the beginning of lockdown, April, the 10-year T-bill was at 47 bips, 0.47%. Recently, we just crossed 5. That gives you an idea what's happening in the market where insurance companies invest. We're getting good money on our investments now. What does that mean? That gets turned around to your clients in the form of dividends, because that is the primary driver for the company's profits. And what we're looking at is a great environment that is really probably pre 1980. Life was pretty steady. That's about where we are right now, and where I think we could end up staying for a good period of time. And I don't think this country can afford to see interest rates creep up that high as it did back in the 80s. We will, I don't even want to talk about what would happen to this country, but I think there's going to be pressure to keep them right around where we're at for a while. That's good for policyholders. More investment income, more dividends. We got creative in what we did, and it really started when we had to reprice the product. Everybody went from the 4% interest rate that Scott was mentioning earlier. We priced our product with a 3% rate as a response to dictations by Congress. What that allowed us to do is, when we got to this point, when interest rates rose, we were going to be able to act far more quickly than we ever have. And we've poured it all back into the policy to make the solutions for your clients even stronger. It is significant increases, rough numbers. If I bought $100,000 base, actually, if I were 40, I'll give you the exact scenario I ran. If I were 40 years old and bought 250,000 of whole life policy, the whole life product we use for DFL Infinite Banking, just death benefit only, I saw a 20 to 30% increase in dividends immediately, only growing, only getting better. It gets significantly better down the road. When we think about how IBC policies are structured, where we don't necessarily emphasize the death benefit and emphasize the accumulation, you're seeing increased dividends to the 70 to 100% mark. PUA dividends, paid up addition dividends, have been hammered as interest rates went down, because that's how life insurance carriers price their products. Because interest rates are up, we can reward those PUA dollars again. So if you're highly funding a policy, you're really going to like what it looks like. Another example, just the impact it had. It was a case, I didn't run it. I saw it. One of our salespeople ran it and sent it out as we were playing around with numbers, trying to understand the impact. But it was a client, they were somewhere between 30 and 40 years old, $500 overfunding their policy. The projected income and the income stream was assumed to be age 66 through age 90, where the policy would stay in force. We were going to draw down far enough that it would still keep the policy in force past what age 100. It actually provides double the income that it did before, and the policy actually stayed in force 3 years longer. So it's a significant impact to these policies. Again, dividends aren't guaranteed. This is as good as the interest rate environment we're in right now, but it's one we haven't seen in a long, long time.
So I just flashed up the 10-year note, a 10-year T-bill
Yeah.
bond, and we hit 5. Actually, it went briefly over 5 points. I guess about a month ago, just before October the 7th, actually. And of course, it's been coming down since October the 7th because of all the additional threats that are happening. But that was very interesting to see that.
And like I said, that's just pictorial. That gives you great insight into understanding where insurance carriers have been able to place money. We don't invest in 10-year T-bills.
Here's another interesting thing to look at with that same chart, just so we can see, because we're talking about what's happened over time. So this is the 5-year look at that 10-year yield. And we are higher than we've been in a long time. This is going back to 2019. And taking it a step further, we are higher than we've been in the last 10 years. This is going back to 2014. And taking it a step further, this is the highest it's been since 2006. So we are in 20 years. This is the best the T-bond has yielded in 20 years. And if anybody remembers what happened in 2008, we went on this long downturn starting in 2008 with the housing market downturn. We were already in a decline from that point, from 2006 on. So if you think of this, this goes back all the way to 2000. So that this is that falling in line with how attractive is this to the market performance. The market took that major dip in 2000, and it didn't really recover until 2013, and then took another major dip in 2008. Didn't recover until 2013. So we're looking at the same kind of trend. We've hit a ceiling in the trading terms. We've hit what's called the upper level of a Bollinger Band, and that is something that is indicative of where the future is going, where we're going from a financial perspective for the company, not company, for the country, and actually for the world. So this is going to be a very solid place to save and store money over the foreseeable future, probably next 10, 15 years, what I've seen. So if you have clients, or if your clients are you or me, for example, if you're looking at a retirement window of 10 years or less, this is exactly where you should be. And it's not as sexy as being in the market, but you're also not going to lose anything. And there's other ways to take advantage of market exposure using derivatives of these programs. And you can still get some of the market gain without the market loss using additional programs. All right. So Mark, back to you. Keep going, brother. I'm just adding color, like I said.
I was attending a meeting, and I was attending a meeting a couple weeks ago, and I was listening to the editor-in-chief, I'll give him that title, definitely the editor of a publication called Life Product Review, and he was talking about product pricing in this interest rate environment, and it was really interesting. Covered MYGAs, fixed index annuities, whole life, and IUL.
For the lay person that's watching this video, a MYGA is a multiple year guaranteed annuity. It's a way to place to put money where you got a guaranteed income stream for a period of time. That's safe.
And they're hot because you can get a good rate right now. Rates go down, nobody will ever buy one.
Right.
Oh shoot, I just lost my train of thought. Hang on, let me get back to it.
You're talking about and pricing of these programs.
Oh, I know. And he says, he was talking about whole life, and he said, listen, whole life is a great product. There are individuals who want to participate. Like, everybody's got a safe portion of their portfolio. You should, right? Economics 101. You diversify. You got safe stuff, you got not safe stuff. Well, some safe investments might be, I want to participate in the bond market. Well, that's great. You can, and you can go get nice little interest rates right now because bonds are trading nicely. You choose your level of risk, but let's say you're risk adverse in the bond market, so you're trading for highly rated bonds. They're pricing out right now, but there's nothing that says that rate can't drop 1.5 in the next 12 months. Nothing is unimaginable in this economy anymore, I don't think. A year and a half from now, if you decide, hey, you want some capital and you want to cash out that bond, are you taking the unrealized loss? Are you taking a loss right now? Because you're not getting what you sold it for. It's not going to trade. Somebody will buy it. Somebody will be willing to buy it, but they're not going to give you what you spent for it. So whole life is a way to participate in the bond market, but do so in a much better way. And hang on, I wrote down his notes because I thought it was fascinating.
You're saying that because of the yield that we're getting from these programs, and the yield is based on the bond market, you're saying that by using this program and taking the gains from this program, the dividends and such, that we are actually vicariously, I guess would be a good way to put it, participating in the bond market without having the actual risk of buying the underlying bond.
Exactly. Your whole life policy is placed with, it's a highly rated credit supported by guarantees. That's what whole life is, right? Dividend interest rates are reflected of a laddered portfolio. We are laddering our investments to provide as steady of a dividend as we can. You have immediate liquidity in whatever you're, dependent on how you funded your policy, you've got access to that liquid part of it.
One
The cash
caveat,
value.
in a par whole life, you have immediate liquidity based on
Correct.
overfunded amount. And some of the
Yeah.
other programs that are out there, you don't have immediate liquidity. Okay.
Yep.
Especially in the IUL market.
And the best part is you have complete control of the tax incidence. We're doing this on a non-MEC basis. So for the most part, so you've got access to your cash tax-free, and you've it's growing tax deferred, and you've got access to that cash tax-free for your life, as long as you do everything right. It's a simple, straightforward product chassis with guarantees. So you get to participate in everything, but you're not exposed to any losses.
And you have freedom for distribution. You have freedom to choose where you go and what you want to do with it. Doesn't mean you can't participate with those other programs when the timing is right. This is just a place to put the money. And that's the beautiful part about that. Taking that loan, once the money hits your account, it's your money. You do whatever you want to do with the money. You want to invest in the market, put it in the market. I would advise against it, but you can do what you want to do. So you're not losing the opportunity to invest and take advantage of whatever XYZ hot stock or hot sector, or maybe you're waiting for BlackRock to get their ETF, their Bitcoin ETF, or their digital currency ETF approved by the Federal Trade Commission. Whatever, you've got access to that stuff, and you can do whatever you want to do when you want to do it. It's a no-brainer for me. It should be a stepping point for everything, because the money's safe. And that's, at the end of the day, if you're looking for a client who's 50 plus years old, that's staring at, a 10-year or a 15-year retirement horizon, this should absolutely be a part of the portfolio. Maybe even like the base of the portfolio, and then distribute risk accordingly elsewhere based on, what your other financial situation looks like.
You're talking to young clients, that's your market. This is the first thing they should absolutely be doing. One, life insurance is like, you tell them what first, life insurance is on sale right now. I promise you it'll only be more expensive tomorrow. Second, the first thing we're taught is what? The first thing you do when you got a job, what were you supposed to do? 6 months of savings, emergency money, just in case you lose your job, right? Okay, I'm going to do this. I'm going to put it there. I've got the ability to use it. And just in case I need it, my emergency money is there. The sooner you start that stuff, as soon as you get that underway, then go to what you want next. Everybody's focused now on, oh, you need to max out your 401k right now. That's great. Can I use it? No. Not really.
No.
Maybe. Yeah. Do that later, if that's what you choose to do.
Yeah. So
this is exciting times.
I love that. You just dropped a really piece of gold there. Life insurance is on sale. So I'm definitely going to be stealing that when I'm talking to my younger clients, because it's true. So true.
Yeah.
All right, Mark, what else you got?
Oh man, I talk a lot. Anybody have questions?
Let's do that. I'm going to go ahead and I'm going to take you off back in gallery. All right, folks. You got Mark Creighton. Ask away. Oh, nice leaderboard action there, Joel. I saw you. I'm watching you, buddy. Great job. Somebody's got to have a question. Really?
Was I just so good? We were so good. We explained
I don't know. If we have to end early, I'm okay with that. That means I get to go eat early, because I got to keep my girlish figure. I'm okay with that.
Hey, maybe we've motivated them and they're all calling clients.
There you go.
They're booking appointments.
Love it.
There's a question in the chat there.
All right. Thank you, Seth. Okay. Can you explain what the delta is? So delta is it's a mathematics term. It just means the difference between point A and point B. So if you have 10 eggs and you take away 5 eggs, the delta is 5. If you have 10 eggs and you take away 3 eggs, the delta is 3. That's all. It just means the difference. Okay. How long until MPL is doing web-based illustrations?
It is a project we're working on. In fact, we talked about this before. We are anxiously awaiting the release of our IUL product. Thank you, states. It is not our fault. It is states' fault. They got to approve a few things. We're just waiting for them to get around to it. Once they do that, that illustration system is going to be on a web-based program, and we will be transitioning. We're working in the background to get all of our other products on there. The last estimate I heard was mid next year. I feel, just to caution you, that that's a little optimistic. I'd be really excited. We're further along than I thought we were. I would expect somewhere in the second half of 2024. Stay tuned. We know if you need help, if you've got a Mac, you know that there's a problem. It doesn't run on the Mac unless you run a parallel program, which allows Windows-based program to work on Mac. Parallel is one of the products that does that. There are others, I understand. And worst comes to worst, please call our sales team. They are tremendously talented and would love to assist you. I know it takes a little time and planning on your part. Can't necessarily work in front of a client, but they can get you what they need. And beg your patience and appreciate it while we get there.
Yeah, you can also reach out to me. I can run them pretty quick. Lee is pretty quick. Joel's pretty quick. Derek's pretty quick. Yeah, pretty much everybody on here is pretty quick. You don't need my help. Go ahead, Ben.
Hey, I just had and maybe you touched on this, Mark, but it's my understanding, I think this is correct. Maybe it's not. If it's not, you can clarify, right, that there is a slight lag in terms of if the interest rates are going down, dividends are going to typically go down. And as the interest rates start going up, because of what you described, the increased profitability of the insurance company, that results in higher dividends. But there is a slight lag in that process, I think. And so you mentioned something about the reaction time, and that, so I'm just kind of curious, when we're looking at, and I know looking at, for the pictorial reference, the T-bill. So where are we like now in terms of, and what can we expect in this conversation about increasing dividends? Is that like starting to happen now? Is that some point in the near future?
I'm afraid to use the word, but I'm going to use it. We got really creative. We put our internal finance team. So one of the advantages that Pan American brought to Mutual Trust is we have an internal investment team, and that investment team is able to go get great returns. The other thing we did, and it started when we repriced our products, we did some things to allow us to move quicker than normal. So usually it's like turning around a cruise ship. And I've seen some dividend announcements from different carriers, and their dividends have gone up just a little bit, which is what I anticipated was going to happen. We made a big jump because of some very safe and like not crazy, but because of some work we did, we were able to take advantage of this interest rate environment immediately. Part of that was also repricing the product was going to give us the ability to jump faster because we're only working with the 3% guarantee. So those interest rates, those bond rates that we're getting, it's more impactful to what we could do with dividends. So yes, traditionally that was true. It was like turning around a cruise ship, each direction. When interest rates went up, you'd see loan rates go up fast and dividends would follow. and then interest rates go down, loan rates go down fast, and then dividends would follow. And it was always a game of chase. Now it's we're able to be a little more responsive and turn that around faster. So yeah, part of it is also insurance carriers, us, for example, we weren't investing. I use the phrase laddered portfolio. You're participating in, the insurance company ladders their investments. So that means we're buying bonds at different durations. We don't want to lock up all our money in 30 year or 10, 20, 30-year bonds. We want some at 5. We want some at 10. We want this low interest rate environment we found ourselves in. Carriers weren't like, what are you going to do? We're getting a bond at 3. And a couple of years ago, we were getting that same bond at 7. I'm not tying up money for 20 years at 3%. So we were going shorter durations. So because investments are turning over faster, we're able to take advantage of better places to put money. So the portfolio yields react faster, dividends react faster. If we stay in this kind of interest rate environment again, let's say hypothetically we stay here for 15 years, and then in year 16 interest rates go up or down, pick a direction. I think you're going to see the traditional lag time take place again.
There's one more piece. The dividend is changing. I know that Bruce Parker sent out a notice the other day.
Yeah.
About the change in the dividend rates, and it's not reflected yet in the quoting software, but he did say that. Go ahead.
For Horizon Value, it has been since the beginning of this month.
Okay.
So that's our IBC DFL product. We wanted that out right away, and we could have waited to do it all at once, but we wanted to share the good news now. So we put it in our flagship product right away. So effective November 1st, anything that was issued November 1st or later enjoys the new dividend scale.
Nice.
For Horizon Legacy, that's our true single premium product, and Horizon Guarantee, that will be available December 1st. However, anything you're selling right now will also get that. You just won't see it. I can tell you the dividend on Horizon Guarantee, or excuse me, the Legacy, the single premium, basically doubled.
All right.
Again, not all cells, don't quote me. You're going to
Sure.
come up with one where it's not quite that, but I'm sorry, not doubled. Example I saw, 5-year cumulative dividend on a case was $1,100. Now it's $4,400.
So 4x. That's what I've been telling people.
Yeah. Sorry.
4x over time dividend increase.
I misspoke. That's true. So yeah, it is very strong.
Okay. And then one last thing, while you just mentioned it. So the primary difference between guarantee and value, they're both par whole life programs, but one's got to focus on growth, the value, and the other's got to focus on DB, right?
Mm-hmm.
There you go.
Yeah, and we also limit. Horizon Guarantee is an incredible product. Should you ever find yourself talking to a client who's looking for guaranteed whole life, and really what they're looking for is just death benefit, where cash accumulation isn't as important, that product maximizes the premium dollar. So I can get the most death benefit for the dollar. I own one of those. I was 53 when I bought it, and our marketing thing when I was out there talking to agents and agencies about it is like, listen, it's a great product. You're going to get the guaranteed, you're going to get the death benefit you want at a great price. And we slope the cash value to the later end to give flexibility. I'm not going to pay for that forever. It is here for a purpose right now to protect my wife. When I just got remarried 3 years ago, I needed to protect her. And my IBC policy wasn't giving me enough death benefit right now. I want her taken care of. Also, additional ideas here. It's also an IBC policy because it's got great cash values. My cash value jump this year is ridiculous. So although we sloped it, my cash value increase in year 3 was really, really close to what I put into it. So close that if I would have just gotten like a 30-year term plan, this is a better purchase. I saved money on my death benefit last year.
So the
It
nugget
is,
to take away from that is if you're writing 30-year term policies, the rising guarantee is going to be a more valuable program.
Mhm.
And then the growth that you're saying, because you just said the magic number, you said 3 years. So when you look at like the cash growth in the legacy program, it's usually somewhere between year 2.4 and 3.0, where you're going to see the cash value of the program catch up to what you originally spent in the program. That's on someone who's a standard rating class. Okay. So, but then at that point, the guarantee program is going to exceed because you've sloped, you've delayed the cash growth in the guarantee programs. You're going to see a faster, which is what you just said. You're going to see a faster growth towards a more mature program.
Yep.
Okay.
Yeah, I learned another cool thing today.
Tell us, Mark.
For those of you who do business with us and have had clients who've taken a loan, we have a procedure for getting loans, and you have to send us a form, right? If you have DocuSign, right now we're also considering some enhancements to this process. If you have DocuSign, you may send the form to your client via DocuSign, have them fill out the loan proceed form through DocuSign, send it into Mutual Trust with the certificate of completion. So we want to know that you use DocuSign. So we're limiting this to just DocuSign. If you send the loan request in via that manner, we will process it.
Nice.
Right?
I'm doing one of those right now. We're doing manual signatures. You're going to get a very, very small gray. Just showing you right now. This is what you're going to receive.
Gotcha.
Small and gray.
Yeah,
I was just going to say, I've been doing that for months. You guys have been taking it.
Oh, well.
I didn't know I wasn't supposed to.
No. Here's the funny thing. I learned this today that we've been doing that. And I'm like,
okay.
Why didn't you tell us we can say that?
I just assumed. I just was doing DocuSign and nobody said no. So
Sometimes regional VPs are the last to know.
I think maybe we should have Leah talking today. Come on, Leah. All right. Well, look, Mark, anything else you want to say? We don't have to stop, but there's no reason to keep going. And you've been talking a lot, and I know we've exercised your voice, and this is the end of your day.
I will. This is. I enjoy this. Again, I see a lot of names I know, and I'm so thankful. It's the season, right? So I say it all the time, but I'm truly thankful for the opportunity, for the relationship I have with Scott and through Scott, and have gotten to know a bunch of you. We are truly blessed for the opportunity to serve you and serve your clients. I mean that from the bottom of my heart. We don't do anything. I have nothing to do if it wasn't for you. So thank you for what you've done. We're getting near the end of the year here. So at the beginning of next year, I'll send you a note that says, let me pay you again. So pay attention to that and take advantage of the offer. It's called free money, the best kind.
Yeah.
And then if you have a policy with us, take that free money and put it in. So you use it again.
Recycle it. Well, Mark, as always, thank you so much. Oh, I'm sorry, Joel. Go ahead, buddy.
Yeah, no, I just real quick, I just wanted to show Mark. I have a new approved mutual trust policy right there. And just real fast, since you brought it up, I just thought I'd ask. The new IUL program that you're talking about.
Yeah.
In a nutshell, how would you position that versus, let's say, the Horizon Value?
I'm laughing because I'm the worst person to ask. Allow me time to learn more. I'm not on that project. One of my colleagues is. What I understand is it's going to be a little different IUL than you're used to, what other carriers offer. It is a simple approach to an IUL. It is going to be a little less mechanics to it. I am told, and it's great because I'm the South region guy, this dog will hunt. My colleague that's on it used to run an agency, his own IMO, and he worked exclusively, almost exclusively in the IUL market. He loves this product. I think you're going to be able to position it as accumulation, as a death benefit option. So stay tuned. We're in the process of putting together meetings where I'm going to learn more. I will tease what I can as soon as I'm able to. But I can tell you, it's really cool. The minimum face amount's 100,000. There, I've extinguished all I know.
And
Okay,
well, you
thanks.
just said one thing though. So where the focus of our organization is, the two ends of the spectrum is the IULE, which is very much a DB focused IUL, and the pass setter, which is very much a growth focused IUL. So this is going to be somewhere in between. And I think, Mark, I heard some rumor that there's going to be basically, it's very basic. There's only about 5 indexing strategies are going to be available, and that's it. Sound
Yeah.
about right? Okay.
Correct.
Okay. So,
Yeah.
Joel, what you just said, I've had the same question come up in my head too. And I'm thinking, well, why don't I do both? If I've got $500 a month of premium, let's split it. I'll put 150 into the IUL and 350 into the Horizon Value. Do them both. Get the best of both worlds.
That's a good way to do it.
All right.
I've always said, use DFL to get them out of the debt so you can sell a bigger IUL later if that's really where they want to go.
Yeah. And then do some annuities at the end, right? 14 people, 14 policies from one program. That's what I'm saying. All right. Anybody else before we get rolling? Well, again, thank you everybody for coming and spending some time with us on Thursday night. Thank you so much, Mark, for showing up and always being a supporter of us. Just thank you again. I know that we've got you. I think you're going to be supporting some of the Purdy initiatives that we're doing. And also, I think you're going to be, we've already talked about this, you'll be supporting our workshops that we've got coming up in February. So I'm looking forward to hanging out with you there. And thank you again for all you guys do. Friedman, the group you guys had on earlier this week, and the trust presentation, that was really, really interesting. And the slats are really, really cool. And if you don't know what a slat is and you missed that presentation, go look it up. It's something you should have in your back pocket. All right.
Oh, hey, a little tease. We announce webinars all the time, and if that's something that you're interested in, hey, I'd rather have you not be there live. Register for the meeting, and you'll get a reminder, but you'll also get a link to the recording later. So no matter what, if it's a subject that interests you, just register. Comes through your email box from Mutual Trust Life Solutions. If you're not getting it, check your spam. If you're really not getting it there either, call me, call our sales team, say, hey, I'm not getting your emails. We'll check that out. Want to make sure you have an opportunity to see that stuff. But yeah, great presentation.
Spousal Lifetime Access Trust. There you go. Well, Mark, thank you again. Thank you, everybody. And if I probably won't, we're not going to be doing one obviously next week for Thanksgiving, but have a happy and safe Thanksgiving. And we'll be back in 2 weeks, which will be the weekend after the radio show. So it'll be a standard DFL presentation in 2 weeks. And everybody have a great holiday. Bye.
Good Thanksgiving, everybody.
All right. Thanks a lot.
Thank you, guys.